Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome my good friend, Dr. Mark Frigo, a man who has been on a similar crusade as myself for many years, but who has different experiences and perspectives. Thank you, Mark, for joining me on our Fortuna Advisors podcast, Create More Value.
Thank you for having me, Greg. Looking forward to it.
Dr. Mark Frigo is a highly acclaimed expert on strategic valuation and strategic lifecycle analysis. Dr. Frigo is professor and founding director of the Center for Strategy Execution and Valuation in the Kellstadt Graduate School of Business at DePaul University, which is devoted to research on high-performance companies. He is a certified public accountant, a certified management accountant, and holds a PhD in econometrics. His professional career has included working as a financial analyst in corporate mergers and acquisitions, corporate strategic planning, banking, and management consulting at KPMG. Dr. Frigo serves as an advisor to CFOs, executive teams, and boards of directors in making the connection between strategy, value creation, and valuation. He is the author of 7 books, including the book Driven, Business Strategy, Human Actions, and the Creation of Wealth, which he co-authored with another good friend, Joel Lippman, and also over 145 articles published in leading business journals, including Harvard Business Review. Dr. Frigo serves on the board of directors of Keeper Security, a leading cybersecurity software company. So, Mark, you interact with a lot of companies. Do you think most companies understand what drives long-term value creation, and do they do a good job of managing for value creation?
Yes, so Greg, that's a great question. Based upon my experience working with CFOs and executive teams, I see a very clear trend toward a greater attention to long-term value creation. This is in part due to the research that shows that companies focused on long-term value creation generally outperform those overly focused on short-termism, which I know is a focus of a lot of your work and my work as well. I also believe that they are increasingly devoting attention to better ways of managing long-term value creation. And as an example of that, I would give, so recently I had the opportunity in Chicago to present an executive education program for a large public company. And the title of the program was How Companies Create Total Shareholder Returns, a long-term value creation. I co-designed the program with the VP of Finance and the VP of Strategy, integrating their strategy with their performance measures of the company and the frameworks that I presented to them on how to create long-term value. So the company basically focused on its key performance indicators, such as ROI, asset turns, margins, and other more detailed metrics, which are all built into their new updated incentive program, which are highly aligned with the return-driven strategy framework, which I presented in the program as a methodology for them to really better integrate their strategy with value creation and valuation. We also used, Greg, applied the strategic lifecycle framework based on the article I did with Bart Madden. And we also integrated into the program the strategic valuation article I wrote with Jeff Madden, as well as the book Driven, which is highly inherently focused on long-term value creation. Tenet 1 is ethically maximize wealth. Wealth is long-term value creation. And the bedrock foundation is strategic performance measurement and valuation, having the metrics that are highly aligned with creating and managing long-term value creation. that would be a great example of the power of some of these frameworks I'm going to be describing later today in our session, as well as a company that's really taking the initiative. The most impressive thing in working with that team was the integration of strategy, value creation, the finance side, as well as the metrics aligned with incentives, right, in terms of which drive the value creation.
Mhm. Well, you mentioned it there, but in late 2020, you and Bart Madden, another person who's on the same crusade, wrote an article titled Strategic Lifecycle Analysis, the Role of the CFO. So, could you explain what is strategic lifecycle analysis and how is it used to help companies?
Yeah, I really enjoyed developing and writing the article, creating the article with Bart Madden, because he and I have worked together for many, many years. He's presented in my center at DePaul University, and the life cycle framework was one of the foundations of the book Driven and Return Driven Strategy that Joe Lippman and I used in our research. So you asked a question, Greg, what is strategic life cycle analysis?
Mhm.
And it really is an approach or a framework that integrates the Bart Madden's life cycle framework with return driven strategy to make it very operational for CFOs and executive teams to make the connection between their reinvestments in the company, return on invested capital, ROI, and value creation, and making sure that there's a disciplined performance measurement system in place which will help them manage long-term value creation. So the framework itself is based upon four phases in the framework, in the life cycle. The four phases in the life cycle would be high innovation, which would be the startups and the high innovation companies. Then you have the companies that are in the competitive fade region, which are still earning good rates of return, but they're facing a competitive fade in their ROIs. And then you have mature companies, number four. And then finally, you have failing business models, distressed businesses, right? We see that many companies are in that mature phase. They're earning average ROIs. They're in a cyclical situation. The companies that we study, the high performing companies, the companies that are the high value creating companies that are sustainable long term value creators, are in that high growth and competitive fade region. Competitive fade is just a natural fact of any company, right? But they resist the competitive fade by making the right investments at the right time in the right parts of the business that will reinvent the company's strategy as well as create a long-term sustainable value creation.
Yeah, it's a great framework. I think lots of companies underinvest in their future, and the framework really gets you to think about, if I do nothing, my performance is going to fade. So what am I going to do to beat the fade? I think that's just a really great way to think about things. So a year earlier than that, you and Bobby Calder wrote The Financial Value of the Brand. And this is really notable for me because we've done a lot of work on intangibles, and several of the previous episodes focused on intangibles. So, what has been your experience trying to bring finance and marketing into alignment inside of companies?
Yeah, that's another piece I really enjoyed working with Bobby Calder from the Kellogg Northwestern um, Kellogg School of Business. He led the marketing department for decades at Kellogg, which is known for their marketing expertise, right? And he's well known for his expertise in brand valuation and brand investments and so forth. He and I met at an academic conference. We saw the connection between trying to make the connection between finance, the CFO, and the CMO, the Chief Marketing Officer. And what we did is we developed a methodology using the life cycle framework, by the way, and looked upon the reinvestments, not just in R&D, but also the reinvestments in brand as being a countermeasure to defeat the competitive fade. And we see many companies, in the early stage of development, like a Tesla, they're really investing a lot in their brands, right? As they should, right? I mean, you see some companies that have become more mature businesses, which underinvest in the brands and then face a competitive phase situation. It's risky to make those investments, but I believe it's much more risky not to make the investments. The status quo is the most risky strategy that you can, the complacency, which I would call it, and which Bart Madden calls it as well, the complacency, I think, is key to avoid the competitive fate from ultimately taking its place in the organization. Currently doing some work with Bobby Calder on brand purpose and how to measure that, how to really define that in the organization using return-driven strategy and also using the strategic life cycle analysis. Another aspect in marketing, you mentioned you're interested in marketing, Greg. Recently did an article with Steve Cahan, who wrote a book on high-velocity digital marketing, which I use in the companies that I advise, and I integrate return-driven strategy along with his methodology, a best-selling Wall Street Journal best-selling book, High Velocity Digital Marketing, on how to measure and manage investments in marketing, which are some of the, as you know, it's some of the most difficult things to do is to measure ROI on marketing, right? It's been always a mystery, right? That's some of the latest work I'm doing with Bobby Calder at Kellogg Northwestern.
Oh, that's really great. Really, really good stuff. Continuing with the theme of talking about some of the articles you've co-authored with, just wonderful thought leaders. A year before that brand article, you and Dominic Barton published the article that started the series in Strategic Finance Magazine, Creating Greater Long-Term Sustainable Value. This, of course, is a subject near and dear to my heart, given my book is titled Curing Corporate Short-Termism, Future Growth versus Current Earnings. If you had to guess, what percentage of companies truly manage for the long term, and what stands in the way of that percentage being at or close to 100%?
Yeah, so the article I did with Dominic Barton, who at the time was the global head of McKinsey & Company, where we integrated the research from the McKinsey Global Institute, as well as FTLC Global. Both are devoted to long-term value creation, and we took the research from my center. But basically, to answer your question, Greg, I think that there's an increasing percentage of companies that are focused on creating long-term value as well as their methodologies. As far as the percentage, I think it differs depending on the industry and the size company that you're referring to. The more entrepreneurial companies that I work with, which would be private companies and some smaller public companies, tend to be more focused on long-term value creation. And the more bureaucratic companies, I would make the distinction between bureaucratic versus entrepreneurial companies. I mean, they're the ones that end up having complacency, and they tend to take the easy way out, which is to take the road of short-termism to competitive fade. So the percentages, I think a majority of companies are trying to manage long-term value creation. Now, you said, do they truly manage long-term value creation? That's going to be, the proof is in the results, right? So, and that's a question. I look at companies and I see companies that are trying, keywords trying, to manage long-term value creation. And you can also often see where there's some gaps in how they're doing it. And you probably see that as well, Greg, in the work you do with companies. But the good news is I see that percentage increasing tremendously over the last few years based upon the research of a number of organizations. I mentioned McKinsey Global Institute, my research, and others, which show the same results. The trend is going to be increasing. The caveat, I would say, Greg, is that we are facing kind of a slowdown currently in the economy, right? When there's a slowdown, budgets get cut, and risk-taking becomes less popular, so to speak, right? So And this is exactly the right time when you have a slowdown, when you want to make aggressive innovation investments in a company, both in its R&D, innovation, and its brand, to avoid and really to take a lead over companies that are not going to be that courageous, may I say.
Mhm.
And by the way, Don Barton was introduced to me by Bart Madden. He highly recommended me to Dominic Barton, who he knows very well as recommended me to him. And that was the genesis of that article.
Hmm. That's a good linkage. I'm going to talk about one more article just because it's such a great series. In 2021, you published Strategic Valuation in the New Economy, in which you speak of how Bart's son, Jeff Madden, makes a compelling case for changing the way investors analyze intangible assets in the new economy. What are the key principles behind this new approach?
Yeah, so that's something I'm very passionate about, Greg, and have been so for decades, right? And it's so strategic valuation is a qualitative and analytical valuation process. It's a logical foundation for properly valuing any company, and I do a lot of work with valuing companies, in terms of M&A and other venues. And it's a foundation to develop and validate the key assumptions in the value drivers in traditional cash flow ROI cash flow valuation models, such as ROI, asset turns, and margins. So that's what we would look at it. We look upon it as three phases, a continual process, right? Strategy analysis using return-driven strategy, intangible asset analysis and new economy using return-driven strategy, and life cycle analysis. And then the third element would be strategic life cycle analysis, and it's continual framework. So the companies get better at it, right? And you have a continual framework. It's a learning process. Now, the investor perspective, when I interviewed Jeff Madden, who's a very successful investor, he mentioned that in the new economy, valuation in new economy requires a focus on management skills, knowledge, building a culture, and distinct capabilities. That's what I would call a genuine asset of our organization, organizational capital. It also can help with the right analytical questions to focus on determining when the company and where the company should be investing its capital. And it also depends on, he makes a very important point, which is that a company can create value no matter where they are on the life cycle continuum. It depends if they're doing the right thing. Are they investing capital in the first phase and second phase? Are they improving productivity and then reinvesting in the mature phase? And third would be, should they be shrinking assets and down from that point of view, the failing business model? So those were the key takeaways. Jeff Matt has presented a number of lectures in my center, and we actually refined in that article. We refined the life cycle framework to focus on ROIs, and we have actually five phases. We divided up the high innovation phase to the early growth stage and high innovation stage, which would be the startups and the high growth companies. And then we have the fading, we renamed it from the competitive fade to a maturing business, right? It's still high ROIs, but it's attracting competitors. It faces competitive fade. If it doesn't continue to reinvest, it will continue to fade to the mature phase and ultimately to the distressed business phase. Another framework that we have used.
That's great. I mean, I can picture looking at the different businesses in a portfolio within a company and looking at where in that life cycle each of them are, and it would dictate a lot in terms of what's important strategically and the reinvestment requirements and so forth. I think it's a great framework. And I'm going to go back to something you said when we spoke recently. You said companies have a myopic view of shareholder value. In essence, if the share price went up or down today, that's drilled home by the tickers on screens and some companies have in their lobbies. What's wrong with this approach?
So I think what's wrong with that business approach, Greg, and I'm sure you recognize it, is that it 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 fosters short-termism, right?
Mhm.
That just by that general nature of short-termism, it can lead to some of the wrong decisions being made, uh, and uh, and really counteracting any of the long-term value creation strategies that may be in place, right? So companies
Mhm.
can speak about long-term value creation, but if they're overly focused on the short-term share price. I mean, as you know, that's an issue and that's a problem that has been with us for decades. It still is here today.
Yeah, I mean, one of the ways I look at that is, using a much simpler model than we think about when we think about the performance of a company. Just earnings per share times the price to earnings multiple gives you a share price. They spend all their time on the EPS and not the things that drive the multiple. And that the investments in the future and the innovation and so forth are what drive the multiple, but they're just focused on the EPS. And I've seen companies that are so focused on the short-term EPS, the multiple keeps sliding and they just blame it on the market. They don't realize it's actually their fault because they're not investing enough in the future. So
Yeah, and
um,
Greg, as we know, there are a lot of problems and issues. I'm a CPA
mhm,
with published earnings per share, right? And that's some of the work that Joe Littman's doing with his Valence research
mhm.
is a good way of looking at how to look at alternative measures that avoid the trap of gap, so to speak.
Yeah, yeah, yeah. So just a couple more questions. Tell me about any crazy or surprising things that have happened in your work with companies over the years.
Greg, I'm glad you asked that question because I was looking back. I have a long career, as you know. I'm not that young anymore. I'm still young in
Neither
spirit.
am I.
But I go back to 2009. Was doing a opening seminar with my graduate course, MBA course at DePaul University on return-driven strategy, and I traditionally invite executives and entrepreneurs to attend that opening morning seminar. Um, I also invite my MBA students to invite their colleagues and people they'd like to invite. So, an MBA JD student from DePaul invited his father, who happened to be president of a private company, Reading Bakery Systems in Reading, Pennsylvania, company that was fairly successful with treading water. It was in that mature phase of a business, right?
Hmm.
And he
Hmm.
sat in the front row of the seminar. And I could tell, well, first, he's probably, what am I doing with all these young MBA students? Because he's about my age. I could tell within 2 minutes that he got it because he was taking copious notes, on what I was saying. 2 weeks later, 2 weeks later, he flew me in his Learjet. He's also a pilot to his strategic planning session in Indianapolis where they were meeting and did a 2-day intensive workshop on return-driven strategy, completely transforming his company, improving its top line, bottom line in the middle of the recession at that time.
Hmm.
2009, 2010 was not a great year for most companies, right? He had record years.
Hmm.
Increased the value of the company, was able to sell the company at a high multiple of earnings, and the earnings were a much, much higher multiple of the before.
Hmm.
And he continues to be an advocate for that framework. He now uses it with private equity firms and those other companies he's working for. The, the,
Hmm.
the, the surprising fun story about it is I had a presentation in 2011, a keynote presentation at a CFO summit in Miami. And I called him up about a week before the summit. And I said, Terry, I'm going to be in Miami. He has a home in West Palm Beach. Terry, I'm going to be in Miami next week presenting at a CFO summit. And the title is Innovating Without Going Broke Using Return Driven Strategy. And I'm going to use your company as a case study. And first it was a pause. I said, let's get together for dinner. He said, Mark, first it was a pause. So I thought maybe he doesn't want to get together for dinner, right? But he
Hmm.
said, Mark, would you like me to co-present with you? And he did a marvelous job. We basically got up on that podium. I presented return driven strategy. He presented the case study in front of about
Hmm.
300 CFOs. And it was just one of the hallmarks of my career in terms of creating value with others and enable them to create greater value, right, with their companies. So he's still today. I did a presentation with him in 2019 before the pandemic in West Palm Beach at another CFO summit, and he continues to be a strong advocate. He presented with me at that particular summit. I brought him in as a surprise guest speaker. I was talking about his case study. Then I said, join us today, and he walked up as a surprise guest, and it was just a great experience.
That's really great. Oh, what a great vote of confidence in the quality of your work that he was willing to come do that. That's really a great story. So let me wrap up. This has been really great, Mark. Let me close with one forward-looking question. How do you think this is going to evolve in the future? Will a greater percentage of companies be focused on creating greater long-term sustainable value in the future?
Yeah, so I think, as I mentioned before, I think the trend is positive. I think that the evidence that companies that focus on managing and being successful at managing long-term value creation, that evidence is going to show other companies that the cost benefit, it's worth it to do it, right? But they need help. They need help because the status quo in companies is doing the same thing over and over again. You know that as an advisor, and so do I. And the hardest challenge is going to be to break that complacency and to improve the way and build the skills and capabilities of managing long-term value creation, such as the workshop I did in May in Chicago with that executive team. But it's going to take skill development. It's going to take leadership at the CFO level, for example. The CFOs that are strategic CFOs, I think, are more likely to take the route of focusing on long-term value creation. The ones that are what I would call CFOs that are not strategic are going to be complacent and just be, continuing on the same pathway. But I'm in the fight with you, Greg, and I know you have the same campaign and the same rationale, and I'm very energetic about assisting companies and management teams in that area, as you are.
Well, that's great. So we've been speaking with Dr. Mark Frigo. Thank you, Mark, for joining us for this very important conversation.
Thank you, Greg. It's been great joining you today. Thank you for the audience for your attention.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.